Right. Just a quick recap. This is a question that we started last week, right? Midweek class. And the guys who are not there, of course, you can always watch the first recording there. All right. I've been having network issues. I'm not sure what's going on, but if you can't hear me clearly, please do let me know so that I can always probably re-explain things or check my connection again. All right. So the first part, it says calculate the taxable income of Stars P2I Limited for the 2020 year of assessment. Clearly indicate and provide a reason where an amount is not allowed as a deduction. All right. So the other party says advise Stars on what the benefits, right, will be if they register as a small business corporation, and if, in your opinion, they should register as one and why. All right. Let's quickly go there and see what's going on here. The accountant of Stars provided you with a list of income and expenses for the 2020 year of assessments. All amounts exclude VAT unless otherwise stated. So we have sales, dividends, self-machine wood, self-factory expenditure and cost, inventory, purchase of raw material, employee expenses, doubtful debts, trademark renewal, donations, machine acquisition, depreciation, rent, and leasehold improvement. The company received dividends of 90,000 from investment in a foreign company and 60,000 from a registered South African company. The foreign dividends do not qualify for exemption in terms of Section 10B of the Income Tax Act. Stars purchased a second-hand machine wood in cash for 517,500, including VAT, on 15 July 2018, and it was brought into use in the process of manufacture on the same date. Machine wood was used to cut specific patterns out of wood to be used in the furniture. The management of Stars decided at the start of the 2020 calendar year to sell machine wood and to replace it with an upgraded machine stone. On 2nd of February 2020, Stars purchased machine stone new and unused for 680,000 and brought it into use in the process of manufacture on the same day. Machine wood was sold to an unconnected company in relation to Stars for 320,000 on 31 January 2020. The accountant determined the following values for inventory for the 2020 year of assessment, and you confirm that these are correct. So cost price, market value, and all that. Raw material purchased from South African supplier for the year of assessment amounted to 6,570,000. Not included in this amount is raw material purchased from an American supplier for an amount of $66 on 31 August 2019. The raw material was received on 25 September 2019. That's transaction date. And the full amount was paid on 5 October 2019. The following exchange rates applied for the 2020 year of assessment. Salaries amounted to 2,980,000 for the 2020 year of assessment. The company also employed a learner employee with no disability who was in possession of an NQF level 5. The registered learner agreement commenced on 1st of April 2019 for a 12-month period and was successfully completed on 31 March 2020. The salary of the learner employee was included in the salaries amount of 2,980,000. The doubtful debt allowance claimed and approved by SARS in 2019 of assessment was 65,000. The accountant provided you with the list of doubtful debtors as of 29 February 2020, which shows a total of 350,000. The company does not apply IFRS 9 principles, right, for financial reporting purposes. The list is broken down as follows. More than 30 days outstanding, 220. More than 60 days outstanding, 105. More than 120 days outstanding, 25,000. Then the total. The list is acceptable to the Commissioner of SARS. On 15 June 2019, Stars renewed the registration period for the trademark they are using in the manufacturing some of their furniture for 8,700. On 31 December 2019, Stars donated 230,000 to Unica and received a valid Section 18A receipt. The accountant calculated the depreciation for the 2020 year of assessment is 167,700, but made no calculation with regards to the allowable wear and tear and capital allowances for income tax purposes. You receive the following information with regards to the assets held by the company. Stars sold its factory building to an unconnected person for $2,500,000 on 15 May 2019. The factory building was purchased for $1,254,000, including VAT, on 4 January 2009 and brought into use on the same date. Computers with a cost price of $120,000 were all purchased on 1st of February 2018. Binding general ruling, the 7 allows for the following write-off periods for assets where applicable: computer other than mainframe, 3 years. Stars signed a new lease agreement with Rosa for the use of an existing factory building on 1st of May 2019. The lease agreement is for a period of 15 years, with an option to extend the lease for another 5 years. A monthly rental of $9,800 was payable to Rosa Limited from 1st of May 2019. The new lease agreement stipulates that Stars had to effect leasehold improvements of $770,000. Stars commenced with the leasehold improvements 1st of July 2019. It was completed on 31 October 2019. A total cost of $770,000 and brought into use on 1st of December 2019. The income will be taxed as gross income in the hands of Rosa. All right, so basically this is what we have. All right, let's look at the calculation of taxable income of Stars. All right, now I want you guys to pay attention because this question consists of almost all the principles that you can encounter with regards to the calculation of taxable income for companies. So it is very important that we pay attention, we ask questions whenever we are stuck. All right. So midweek, all right, we did look at the components, all right, which are making up in terms of this. So we did start off with the calculation of taxable income, all right, whereby we said, so assume Stars is not a small business. Remember, we did mention there in terms of the background information. It was never mentioned if Stars was a big company or a small business. So we started off with the sales amount, 12.5. Then we looked at dividends received of 150, whereby we said we include the dividend amount into the gross income, as you can see there. All right, then we referred to note 1, whereby we said the company received dividends of 90,000 from an investment in a foreign company and 60,000 from a registered South African company. So in terms of the dividend, that 150 includes local dividends, and it also includes foreign dividends. All right, that's where we are. And then we said, because of the definition of gross income, we first include the dividend amount. We include it in gross income. Then we do exemption. All right, so we do exempt. So South African dividends, which are called local dividend, they are fully exempt. In other words, they are not subject to tax. The logic behind that is local dividends, they are subject to separate tax that we call dividend tax. All right, that's why it's not fair. All right, I'm sure you guys agree with me that it's not fair for an amount to be taxed in normal tax, then it's also taxed as part of dividend tax. So that is why local dividends, we exempt them fully because they are subject to dividends tax. Dividend tax is a tax whereby South African dividends are taxed at 20%. All right, so basically you take it out. Then foreign dividends coming from a foreign company. So we said, in regards to this, if you hold less than 10% shareholding in a foreign company, there's a partial exemption. So you get an exemption of 7 out of 27%. All right, so in regards to the foreign dividends, all right, I did write the notes there. All right, so if foreign dividends, you hold less than 10% shareholding in that foreign company, you get 7 out of 27. Then if you have more than 10% shareholding in a foreign company, you get full dividend exemption. All right. And then also, whilst we still there, we also mentioned that dividends that come from real estate investment trust, there's no exemption. So those ones, they do not qualify for any form of exemption. So if you see dividend coming from real estate investment trust, there's no exemption. All right, I hope it's making sense. Then we moved on. All right, from there, all right, we include our dividend, then they self-machine wood. All right, and then they gave us under note 2. So Stars purchased wood second hand in cash for 517,500. So we say the cost, we need to remove VAT from this cost, all right, because Stars is a registered VAT vendor and this amount includes VAT. So we multiply the 517,500 by 100 over 115. As you can see, we are removing the VAT. Now, machine wood was acquired second hand. All right, so in regards to this, machine wood was acquired second hand. So I'm going to write some notes there. So machine wood, right? So machine wood, all right, as you can see, this machine was bought second hand. All right, this machine was acquired second hand. Therefore, it was acquired second hand and is used in manufacturing. Therefore, allowance of 20% per annum applies. Right? So it's important that you understand when something, a machine is bought second hand, right? And something is bought second hand, all right, we claim allowances of 20% every year. All right? So that's what we have in terms of this part. So you see there we have our allowance, all right? When it comes to machine wood, we claimed our allowance at 20% there, all right? So even if machine wood was sold, as you can see, all right, you can see that machine wood, all right, was used out of specific and they sold it. If you look at it, all right, so machine wood actually was sold, Stars, on 31 January 2020. As you can see, it was sold on this date. Now, do you see, if you look, the year end of the company, right, is 20th February 2020, all right? But now you can see that machine wood was used for 11 months, all right? But now, which means now, because we are applying this section, 12C, we do not apportion the allowance. You claim the full allowance, all right? You can see that's why we have allowance on machine wood at 20%. We do not multiply with 11 out of 12. Now let's look at machine stone, all right? There was machine stone. You see, on 2nd of February 2020, if you look at it, 2nd of February 2020, Stars purchased machine stone, new and unused, for 680,000. Do you see, machine stone was used for 1 month, all right? And also machine stone was bought new and unused, all right? So let's write some small notes there. So machine stone, right? This machine was acquired new and unused. Therefore, allowance of 40% in the first year, then 20%, and then 20%, and then 20%. So these are the allowances that you claim with regards to this machine. So you claim 40, 20, 20, even though the machine was used for 1 month. All right, as you can see, it was bought on 2nd of February. All right, so in this regard, we claim the full allowance. So you have allowance at 40%. Right. Then we looked at, in terms of this, all right, we looked at another aspect, all right, with regards to this part. I'm going to come back in regards to this. I'm going to do recoupments, all right. I'm going to do capital gains tax with regards to these machines, all right. But for now, let me just do with allowances one step at a time, all right. And then we have self-factory, that's under 9, all right. Let's and before we get there, right, I think we skip the self-factory because there is Okay, let's just do 9. I'm sure there's allowances on the factory. All right, let's look at it. All right. The accountant calculate the depreciation for the 2020 year of assessment is 167,700. Now, this is not tax rule. All right, so you don't deduct this amount. This is an accounting principle. We deal with SARS principles. All right, but made no calculation with regards to allowable warranty allowance and capital allowances for income tax purposes. All right, you receive the following information regarding to the assets held by the company. Star sold factory building to unconnected person for 2,500,000 on 15 May 2019. The factory building was purchased for 1,254,000 on 4 January 2009 and brought into use on the same date. Now, do you see the factory building? Let's deal with the factory building here. Now, factory building is the same as manufacturing building. So you claim your allowance in terms of section 13, all right, of the income tax. So you have your section 13 allowance on the factory building. So how are you going to claim it? All right, so you can see the cost of the factory building is 1254. So you take 1254 times 100 over 115 times 5%. All right. So in regards to this, remember, you had the building in 2009. All right. But the cost includes VAT, so you take out VAT. But using 115, all right, times 5%. All right, it's a deduction, of course. So allowances, you record them as deduction amounts. All right. Fantastic. So that's how we go about it when we're dealing with factory buildings. All right, let's look at the next part. In terms of this, all right, so we have factory buildings. We done with that. So far we haven't done about the cell, right? We're just looking at the allowances. Let's look at computers. You see, computers with a cost of 120 were purchased on 1st of February 2009, right? So we have computers, allowance on computers, all right? So allowance. Now, computers now, we claim allowances in terms of section 11E, all right? These are small items, all right? So we have 120,000. So we're just going to use the general binding ruling, all right, which is 3 years, all right? So we have 120 divided by 3. Now, let's look at it. Now, I want you guys to see something, how the examiners catch us now. When you're applying the rules for section 11E, which is for small items, all right? This computer was bought on 1st of February 2019. It's subject to 3 years. So we use it 2018, all right, to 2019. That's 12 months, all right? 2019 to 2020. That's another 12 months. So it looks like in regards to this question, all right, the computer is still left with, we used it for the full year. So we're just going to divide by 3 like this, all right? We're not going to multiply it with anything. All right, so we have minus 120 divided by 3. So it gives us our allowance now of 40,000, right? And so that's that. And then let's look at inventory. So we have dealt with the inventory, whereby we said inventory is measured at law of cost and not realizable value. Let's look at it. The accountant determined the following values for inventory, all right, for the 2020 year of assessment. You confirm that these are correct. So cost 2,487,000, all right, and then market value is this. So we said opening inventory. You can see this is inventory at the beginning of the year. Remember, our year runs from 1st of March 2019. So we use the lesser between the two. So we use opening inventory is going to be lesser, which is 2,487,000. So if you check opening inventory, we recorded it 2,487,000. Then closing inventory, we use the lesser as well. You can see 1,440,000 is the lesser. So we measure it this amount. All right. So that's what we have. Opening inventory deduct, closing inventory we add. Then Let's look on to move note 4, purchase of raw materials, right? As you can see, we have purchase of raw materials that we have there, all right? Let's quickly see what's going on in terms of the purchase of the raw materials there, all right? So raw materials under note 4, all right? So we have raw material purchase from South African supplier to the year of assessment amounted to 6,570,000. All right, let's include it. All right, so we have purchase of raw materials. Right, so purchase of raw materials is a deduction, all right, with regards to the calculation of tax. So 6570. You have it there? There's a deduction there. Right. Then we move on. Right after that, we move on to the next step. We want to see what is going on next. So not included in this amount is raw materials purchased from an American supplier for an amount of 66,000 on 31 August 2019. The raw material was received on 25 February 2019, transaction debt, and the full amount was paid on 5 October 2019. Right, let's write a little bit of notes, all right? Foreign transactions. Right. There is different rules that applies when you're dealing with foreign transactions. So SARS says, okay, you can buy transactions from a foreign country. The first thing, all right, that we need to do, so translation, right, of foreign transaction is based on spot rate on transaction. It is spot rate on, we use what we call transaction debt. All right, so we use the spot rate on the transaction debt. All right, now for foreign transactions shipped, right? Shipped, FOB. FOB stands for free on board. All right, we use spot rate on this debt. All right, so if you see in the exam, they give you information whereby they're telling you that the goods were shipped free on board. So the spot rate that you use to translate is the one that we have in regards to this shipment debt. All right, which means now on raw materials, so for foreign raw materials, right, we're going to translate. Do you see there's 66,000 of raw material that they bought? So we're going to translate it now using the spot rate, all right? On this switch date on 25 September 2019, which is they told us that the transaction date. So we're going to use this rate. Right, so we have 66,000 times 13.89. Right, so you then sit with it here. It's a purchase, so 66,000 times 13.89. All right, so it's going to take us to this balance there. All right, so that is what we have in regards to the foreign transaction that we have on this transaction there. The next thing now, right, that we're going to have, all right, in regards to this part. Now, if you guys look at it, do you see the full amount was paid on 5 October 2019? Right, let's look at it. What happens if payment of foreign transaction is delayed? Right, I know you guys did this principle in your FAC, right? When payment is delayed, we need to calculate foreign exchange gain or loss. All right, we need to calculate if there's a foreign exchange gain or loss. So we calculate foreign exchange gain or loss, all right, at year end. All right, so calculate the foreign exchange gain at earlier of year end or settlement date. Whatever happens first, we calculate the foreign exchange gain based on that. So what are we saying in regards to this? Now, remember, you bought material on credit. So you're saying in regards to this, if you had paid the supplier, all right, on 13 September, also on 25 September, you could have paid 66,000 times 13.89. But you delayed paying. Do you see? You paid the supplier now on 5 October 2019. This is the day you are paying. All right. Now the rate is now sitting at 13.18. Do you see you have made a gain? You're now paying lesser rands. All right. Look at it. All right. On 25 September 2019, you could have paid 13.89 times 66,000. Do you see? So in regards to this, you could have paid more rands. Right? You're going to pay 916,000. But now you chose to pay on 4th October 2019. How many rands are you paying there? So you're going to pay 66,000 times 13.18. All right, which will give us 869. Do you see? You are paying 869,880, which means you have a gain. All right, in regards to this, you're paying less. All right, do you see? That's a gain in your books. So you gained how much? The difference between the two amounts, which is 46,816. Right, so you have a foreign exchange gain. So you're going to record here foreign exchange gain. SARS wants to tax you. You know, the taxman does not play. They want to tax you on this gain. So you can alternatively, you could take 13.89 minus 13.18, right? Times 66,000. So that's an alternative calculation. You could have gone about it as well. Right. Right. Just out of interest, right? You can see this 46 and 46. Out of interest. So last week, I'm traveling from wherever I was coming from. So I traveled with old people, all right? I was just sitting next to some old people. So do you know what those guys were saying? So the old lady was like, yo, this is a good time to be buying foreign currency, right? You see the rand is gaining now. It's a good time to be buying foreign currency. You sell it when the rand starts losing. So I thought of you guys. I was like, okay. So if the old people can actually think about this, and I'm sure that those guys were like in their 70s or so, right? They're talking about the rand gaining and all those things. I was like, okay, I have my guys. I teach them almost every now and then. Right? Do they know that the things I teach them, they apply in real life, right? We can all agree that you may opt, right? Just this section, do you know that there's somebody who lives, right? They survive on foreign currency trading, right? There are people who do that. And there's, if you look at it, for example, Standard Bank, right? There's offshore accounts. You can buy foreign currency, all right? So the point I'm trying to raise is the studies that I give you guys, it's not only for you to pass, all right? But also you can apply these things in real life, all right? You can make money out of it. Not all of us are going to end up as into tax. Not all of us are going to end up as CA. But one can actually say, I understood the foreign currency transaction. I can earn a living from that. You know that. Somebody can say, no, I understood my tax. I'm going to start my own practice. You can earn a living from that. All right? So do not only take the studies as a way to just pass and you forget. All right? But take the studies as a way now that you can actually brighten up your future in some areas. I remember last year, was it last year or this year? I don't remember. I'm sure Miss Manas agree with me. She was presenting to she's in the medical. She was presenting to colleagues about the rebates, right, about tax. And she was telling me the things we did in class is exactly the stuff I was presenting to my guys. I was coaching them how the rebates work. So you see, so when we do these things, never think that no, you're never going to experience them in real life. This is real life stuff. All right. So always make sure you concentrate and understand there. Yes, she's confirming that yes, she was actually presenting to her colleagues there. All right. Cool, guys. So let's look on to the next part, all right, in terms of this. And then, so we're done with raw material. Then we look at employee expenses, all right, under 5. Let's see what's going on there. So salaries amounted to 2,980,000 for the 2020 year of assessment. So the salaries are deducted, right? Of course, so we need to deduct those amounts, right? Right. So we have salaries, right? We're going to get a deduction, full deduction, and salaries. There's no two ways about it. All right. So we have salaries 2,980,000. All right. So that's that. All right. And then let's proceed with our information. The company also employed a learner with no disability. Be careful with these learnership agreements. All right. Please, guys, you can't afford to lose easy marks in terms of learnership agreements. The examiner knows it is more likely they will examine you on learnership agreements. Let's look at it. All right, a quick recap. Now, learnership agreements, there's small rules that we spoke about this. So we said employer, all right, when you employ a learner, all right, gets an allowance, all right, employer allowance. Right? If you have a learner now who's in NQF, all right, so if you have a learner with NQF 1 to 6, all right, you get a deduction of 40,000 per annum, all right? So in other words, I'm sure you guys have seen those learnerships, all right, whether some companies will be saying, now, this is a learnership, all right, you can apply for the learnership. Some of you guys will be doing articles, all right, it can be PsyCA, it can be SciPy, it can be no, not cyber does not do this for business. I think ACCA, CIMA, and the list is endless. If you're doing those articles, all right, your employer, depending on the level of qualification, they'll be claiming these allowances. All right, so it's more like you're a benefit to the company, all right, because your employer is using you to reduce their tax. All right, so that's what's happening then. And then, so no disability. All right, so if you employ someone with no disability in NQF level 1 to 6, you claim that. Then NQF 1 to 6 as well, with a disability, you claim an allowance of 60,000 per annum, all right, with disability. If the employee has a disability, so that's your allowance, all right. And then completion allowance, right? So your completion allowance, you take for NQF level 1 to 6, you're going to take now years of learnership times allowance granted. All right. So in this case, if it was a learner with a disability, then they were in a learnership for 2 years, take 60,000 times 2. All right. If it's a learner with no disability, they were in learnership for 3 years, you take 3 years times 40,000. All right. And then NQF, right? 7. All right. We're looking at NQF 7 to 10. All right. The guys now are doing the degree guys, which is more or less like you guys, all right, by end of the year. So your employer will get an allowance of 20,000 per annum, provided you don't have a disability. All right. So they get 20,000 there. All right. NQF 7 to 10, all right? So your employer will get a deduction of 20,000 plus 30,000, making it 50,000 per annum, all right, with disability, if the employee has a disability, all right? And then completion, still the same, right? So it will still be this. So your allowance times that. So that's how it works in terms of the learnerships. So it's important that you remember these principles, and they love examining it. All right. So remember that part of learnership. These are the notes that you can make use of, all right, in preparation of the exam. Now let's look at the question that we're dealing with. All right. Do you see? So salaries amounted to this, all right, and the company employed a learner with no disability who is in position of NQF 5. So we're looking at NQF 1 to 6, all right? So there's an allowance of 40,000 because there's no disability. The registered learnership agreement commenced on 1st of April 2019. Right now, the problem now that we have now is the learnership was running for it started in the middle of the year. Remember, our year end is 20th February, right? Say the year end of the company is 20th February. So which means now, all right, allowance, learnership, allowance, all right? Because now they were in NQF 5, so there's 40,000. But however, now the problem is the employee was not employed for the whole year. You see, he started employment on 1st of April. So we have April, May, June, July, August, September, October, November, December, January, February. So multiply with 11 out of 12. Right. The learner was not employed for the whole year. Right. So we have 40,000 times 11 out of 12. Then completion allowance. We're going to get 0. So it was done following year. Right. I'm sure you saw that completion took place at the end of March. All right. In terms of this question, so being told now that the completion of the learnership, you see, completed on 31 March 2020. Remember, our year is 20 February 2020. All right. So in regards to this, we don't include it there. Right. So that's that about the learnership. Please remember that principle. So completion, there'll be a mark for this. Just writing that you get a 0. They will award you a mark there because it shows you know what you're doing. Doubtful debts. All right, let's look at doubtful debts. It's another principle they love. All right, and also you need to know what's happening. Now, in terms of doubtful debts, you need to pay attention. Some companies will be using IFRS 9. All right, so IFRS 9, if a question says the company uses the rules of IFRS 9, so it means now you use 40% times lifetime allowance. All right, IFRS 9, you do that on your FAC, where you do allowance for credit losses. If there's significant impairment, you calculate lifetime allowances and all that. Of course, you guys don't need to worry about that. They'll tell you that this is a lifetime allowance or this is a 12-month allowance. All right, then for the other part, all right, you use 25%, all right, of 12-month allowance. All right, if you're given an allowance for 12 months, you multiply with 25%. If you're given lifetime allowance, you multiply with 40%. All right, IFRS 9 not applicable. All right, some companies, they're still not applying IFRS 9. So the examiner will tell you that IFRS 9 is not applicable, which means now your allowance for doubtful debt, right, that you have, all right, so you have for debtors that are more than 120 days. All right, if you have debt that is sitting in to say it's more than 120 days old. All right, so in regards to this, you multiply now that debt with 40%. All right, if it's more than 120 days old. All right, more than 120 days, 40% times allowance. And then less than So it's more than 60 days, but less than 120. So here you multiply with 25%. Right? So basically that's how you claim your allowances for doubtful debt. Right. Please, guys, I might not get a chance to come back and explain these things in more detail like I did. So I urge you, run through these notes. All right. So we have our allowance. All right. Let's quickly look at the question there. All right. The doubtful debt allowance claimed and approved by SARS in the 2019 financial year of assessment was 65,000. The accountant provided you with a list of doubtful debt. All right, first for starters, allowance from the previous year. Do you see this was 2019? We reverse that. All right, so allowance for doubtful debt. Right, so we have prior year, which is 2019. So we add back the allowance that was raised in the previous year. We need to add it back. So we add back the 65,000. Right, and then we have allowance for 2020. Right, so let's quickly look at it. What is happening? All right, so the accountant provided you with a list of doubtful debt at 29 February 2020, which shows a total of 350,000, which is this. The company does not apply IFRS 9 for financial reporting purposes. Do you see? So in terms of this, right? Remember, we have a company applying IFRS 9 and a company that does not apply IFRS 9. So here applies IFRS 9, here does not apply IFRS 9. So we're at this stage now, whereby we're told IFRS 9 is not applicable. All right, which means now 30 days outstanding, there's nothing, you don't do anything. So these ones are more than 60 days. So you take 105. All right, so you have more than 60 days. So you take the 105,000 times 25%. So that's your allowance that you claim there. Right? So it's sitting there. All right. And then you look at more than 120 days. All right. So here you have more than 120 days. So what is your allowance in regards to that? So you take 25,000 times 40%. So that is the allowance that you claim there. So 25,000 times 40%, it will take you to this amount. So right, so that's that in terms of allowances. All right, and then you proceed, all right, to the next aspects, all right, of this question then. All right. So the next part now that we need to look at, all right, in terms of the allowance. So we have trademark renewal, all right? So trademark renewal, let's look at it, all right? Section 12 GC, right? So we have trademark, patent, design, all right? Let's look at this. So no allowance on trademark. So you don't get an allowance, right, on trademark. So allowance is 0, right? When you purchase a trademark, there's no allowance, right? And then patent, allowance is at 5%, right? If you own a patent, allowance is at 5%. Design, right? Allowance is at 10%, right? So remember that. And then renewal cost, all right? Renewal cost fully deducted. So if you have renewal cost on allowance, patent, all right, trademark, design, and all that. So if they are renewal cost, these are fully deducted, all right, in regards to these parts, all right. That's basically what we have in terms of this. Right, let's quickly look at the next part, all right, in terms of in terms of this. So we have it sitting there. All right, so let's quickly see what's going on in terms of these aspects. So in terms of this, all right, let's go to the question and see what's going on there. So that fed us to 7. So on 15 June 2019, STARS renewed the registration period for the trademark they're using in the manufacturing of some of their machine for 8.7. Do you see this is a renewal? So renewal of trademark, right? So you're going to get a full deduction at cost in terms of renewal, right? So 8.7. So you get a deduction for renewal, all right? And then let's look at the next one. All right, we're done with that renewal and the 7. Then there's donation. So donation, all right, let's discuss a little bit about that. Donation, all right. So in terms of SARS, right, if you donate to a registered public benefit organization, so donation to a registered public benefit organization, right, with Section 18A certificate. All right, if you donate to such type of a company, you get a deduction. All right, there's a deduction of donation amount limited to 10% of taxable income. All right. So in regards to the donation, if you make a donation to a registered public benefit organization, so you get a deduction, right, in regards to this, which is sitting at 10%. So the donation amount limited to 10% of your taxable income. So that's how it works in terms of donation. So we'll come back, all right? Of course, we're going to come back to the donation because it's done last. So we do the donation at the end, right? And then machine acquisition, 2 is we have dealt with that. Depreciation, so you can write down depreciation. So you can write down depreciation, all right? Accounting principle, right? Then you put a 0 there to show the examiner does not have any tax implication there. And then rent and leasehold improvement. It's quite an interesting one. Right? You need to pay attention in terms of these principles. Now, rent and leasehold improvement. Let's quickly look at it to see what's happening. So in terms of rent and leasehold improvements now, all right, there's quite a few things that we need to look at, all right, in terms of that. Now, rent and leasehold. So rent expense is deducted, of course, all right? Rent expense is deducted. And then the issue that you have is on improvement, all right? So what is happening in terms of improvement? Now, the lessee, who is the tenant, of course, all right, will get an allowance on improvement, all right? So the allowance, all right, in regards to this improvement, so we take approved or agreed improvement amount, all right, divided by remaining lease term, all right? So this is the allowance that you get when it comes to leasehold improvement, all right? And then if the improvement is on manufacturing building, all right, and there is an excess amount, all right? So in other words, we're saying the lessee spend more than agreed amount, all right? So there's an if the improvement is on manufacturing building and there's an excess amount, all right? So lessee spend more than agreed amount, all right? The excess amount the lessee will receive will claim Section 13 allowance on the excess amount. In other words, they'll claim 5% allowance times difference between actual cost of improvement and actual cost of improvement and agreed amount. All right, so you claim an allowance. So the only time, all right, with regards to leasehold improvement is when you spend more than the agreed amount. And however, the improvement is with regards to manufacturing building. All right, I believe you guys don't do, what do you call this? Municipality, Section 12N, all right, where we talk about improvement on municipality land, all right? So in terms of that, I think it becomes a little bit of a different, whereby the lessee will just claim for allowance on the improvement of municipality or government land. All right, but I'm not too sure if you cover that, but let me just write that. Section 12N, all right? If let's see effect improvement on government land or building. All right, by government, we're looking at municipalities. Right, so effect improvement on that. So the lessee will claim allowance of 5% on the improvement. All right, so this section only applies if you're renting from the government, of course. Right, now let's look at the renter, all right, and this other part there. Let's see what's happening in our question there. So this is not 10. Well, let's see what's happened. So Stars signed a new lease agreement with Rosa for the use of an existing factory building, 1st of May, 2019. The lease agreement is for a period of 15 years with the option to extend the lease for another 5 years. A monthly rent of 9.8 was payable to Rosa. Do you see? So in regards to this, there's rental expense, all right, which is, so in terms of this, there's 9.8 times, so they entered into the lease on 1st of May. So 1st of May, 2019 up until 20th February 2020. So there's how many months? May, June, July, August, September, October, November, December, January, February, March, April, May. Sorry. May, June, July, August, September, October, November, December, January, February. That's like 10 months. So multiply by 10. So this is the rent. All right, so we have 9.8 times 10. It's rent expense deduction. So it's sitting there, all right? We have it sitting at this part, all right? It's that amount. And then after that, all right, the new lease agreement stipulates that Stars to effect improvement of 7.7. Right? So in terms of this, there's improvement which is affected. Stars commenced, so we have leasehold improvement. Right? Do you see the agreed amount is this amount, 7.7. So we calculate our leasehold improvement on 7.7 divided by remaining lease term. All right. Now, when was the lease completed? Do you see the lease was completed on 31 October 2019. So how many months? What is the remaining lease period between 31 October 2019 up until the lease term? So in terms of this, remaining lease term, right? So you look at total lease period. So in regards to this, what is the total lease period? So they entered into a lease, 15 years. So 15 times 12, it takes us to how much? Give us, take us to 180. Less used months. Right? How many months did they use? So we are saying they entered in the list on 1st of May. All right, so we have May, 1st of May until 31 October 2019. All right, so 1st of May until 31 October. There's how many months? All right, so you have May, June, July, August, September, October, November, December, January, February, March, April. That's 12, right? April, May, June, July, August, September, October. All right, that's a total of 18 months, right? So you can say minus 18. So which means the remaining periods now. It's going to take us to the net of this. All right. So you're going to divide with 162 months. All right. So 162 months from 31 October. So now October up until 28th February, there's how many months? Right. So you have November, December, January, February. That's 4. So you then multiply by 4 months. So this is your leasehold improvement allowance, which you're going to claim in regards to this. So it takes you to this amount, right? In terms of the lease. Any questions, guys?
Hi, can I ask something?
Yes, ma'am.
Yeah, the one that you said minus used month, how come did you arrive at 18
18.
from 18 from 1st May until 31st October?
So what is happening is this, all right? So we said from 1st of May, right? 1st of
Yeah.
May. Oh, it's 1st of May 2019. And that, oh, so thanks for that. Actually, it's May, June, July, August, September, October. That's like 6 months. My mistake there. I'm sorry. So it's actually 6 months, not 18. I thought it was the following year. So we divide with 174 there. All right. Sorry about it. Thanks for noting that. So we divide with 174. Right.
Also, the 180.
Hmm.
How did we get to 180 again? Can we just check?
So remember, our lease term is for 15 years, right? The lease period, 15 years. So we converted 15 years to months. So we took 15 times 12. It gave us 180, right? Remember, the lease period is 15 years. So we just converted to months. The logic behind this is one can choose to say, I want to work with years. All right, you could do that. You could have just said 15 minus 0.5, it will give you 14.5, I think. Then you divide like that. But I don't like working with that because I prefer, if I'm doing with months, let me just work with months without any disturbance. So it just says, okay, let me convert everything to months. All right, I'm working with my months, 180. This is the entire lease period minus the period that is elapsed, so remain with 174 months. Now, I entered into this lease. All right, lease was completed in October, which means now the improvement, I need to claim allowance, all right? 174 is per month, all right? So I have November, December, January, February. So that means it will take me to 4 months, hence we multiply with 4. Now, is there any excess on leasehold improvement? So in this case, we saw that they spend 170 minus 170. So there's no excess allowance that needs to be claimed there. Right? But let's say, for example, if they spend maybe 800,000, right? Just as an example, we're going to take 800 minus 770. Then we multiply with 55% because it's effectual building. So that was going to be an additional allowance. But however, because there was no additional cost, all right, section 13 allowance on list, all right, not applicable, all right, because they spend the exactly same amount that was commented on the list there. All right, questions, guys? Now, the important principles now that I want you to look at, all right? Right, let's look at some important principles. Yes, sir. Okay. The important principles now, I want us to look at recoupment and capital gain. Right? These are very important principles that I want us to discuss in terms of this. Right? Now, whenever there's a sale of an asset, we should calculate recoupment and capital gain. So whenever you see that an asset has been sold, you should be in position to calculate recoupment and capital gain. Right? Whenever you're facing that, you should do that. All right. So now, how do you calculate recoupment? How do you calculate capital gain and all that? That's what we want to look at. So recoupment. Right. So that's what we have. So recoupment. I know there's two methods that one go about it, right? But I prefer this method. So recoupment is selling price limited to cost. Right? So selling price limited to cost less tax value. All right. So you deduct tax value, that's what will give you recoupment there. All right. How do you calculate tax value? Tax value is cost. All right. Less total allowances. All right. From the date you bought the asset until today's terms. That's what will give you your tax value there. All right. So the net between these two, all right, is what will give you the tax value. All right. We then use cost, selling price limited to cost, minus that. So to give you recoupment. All right, let's do that. Let's practice that. All right, in terms of this. So we saw there was a sale of machine. All right, there was a machine that was sold there. Machine wood. All right, machine wood. All right, let's do the calculation there. So we have recoupment on machine wood. So selling price limited to cost. All right, let's see. So in other words, we're saying the lesser between the selling price and cost. So what is the selling price of machine wood? All right, it was bought for 517,500. What is the cost of machine wood? So the cost is that, and then the selling price is 320. You can see 320, all right, 517,500. I think it becomes 517,500. I just want to see which one is bigger. So 517,500 times 100. It's 450. You see 450 and 320. 320 is less than 450. So we're going to use the less amount, right, which is 320. Right? So that's what we use, right? And then less tax value. Right. Tax value, we said is cost. So cost of our machine, all right, is going to take us now to 517,500. 517,500 times 100 over 1.5. All right, the cost of the machine is 517,500 times 100 over 1.5. See, it gives us 450. That's the cost. Then allowances, right? So we need to deduct the allowances of machine wood. When was machine wood purchased? See, it was purchased in 15 July 2018, which means we claimed allowance in 2019, right? For 15 times 20%. Remember, it was bought second hand, all right? So we deduct the allowance for this year, right? And then we have allowance for 2020, right? With 450 times another 20% then, all right? This is for 2020. So these are the total allowances that we claimed in regards to machine wood, all right? So tax value now is going to be cost minus these allowances. All right, do you see? So in terms of this, give us 270 there. All right, so we have 270 there. So now, which means now, regards to this, all right, recoupment is going to be 320 minus 270. So we have recoupment. It's going to be 320 minus 270. So it's going to give us our recoupment amount, right? Which is going to be the difference between these two assets. So it's 50,000 recoupment. Right. So under normal circumstances, we're going to get, we're supposed to get, to include this recoupment in our taxable income. All right. But now, because it's a replacement asset, all right? Because it's a replacement asset, all right? You saw machine, stone was replaced by machine wood. The recoupment will be taxed to the extent of allowance on replacement asset. All right, so which means now, all right, the recoupment allowed, so we call it deferred recoupment. All right, so we're going to get the recoupment of 50,000 times 40%. Why 40%? Where is 40% coming from? Remember, machine stone was acquired in new and unused, which means on machine stone, you're going to be claiming allowance of 40%. So that will mean now the amount of the recoupment that you include here will be times 40%. Now, this principle only applies with regards to replacement asset. All right, please remember that principle. You cannot afford to ignore that. All right, they love examining it. All right, they did not examine it last year, if my memory serves me right, which means it stands a good chance of being examined this year. Questions, guys? Yeah, cool. Let's proceed now, all right, to the next part. So the next part now, all right, is about, it is going to be about capital gain, all right, in terms of these assets. All right, so capital gain, machine wood. So we have proceeds. So proceeds is selling price minus recoupment. All right, that's what it gives us, the proceeds. So which means now proceeds, all right, of course I have to show you the formula. So the selling price, and what is the selling price of machine wood? So there's 320,000 minus recoupment. So you take the full recoupment, which is 50,000. All right, so the proceeds, all right, it's sitting at 320 minus 50,000. Take us to this amount, 270. Less best cost. All right, so there were no improvements to machine wood, there were no additional costs. So best cost will be the same as tax value. So it's cost minus allowances. All right, so which is the same as your tax value that you calculated there. So it takes us to 270,000. All right, that means there's no capital gain in terms of machine wood. So capital gain sitting at 0. All right, you have it at 0 there. Right, let's move on. Manufacturing building. There was a building that was sold as well. All right, where is it? Here. It was sold there. All right, so manufacturing building, equipment, manufacturing building. Let's quickly see what is going on there. Now, so Stars sold this factory building to a connected person for $2,550,000 in May 2019. The factory building was purchased for $1,254, including VAT on for January 29. So we do recoupment. So it's selling price limited to cost. So you can see the cost is 1254, including VAT. So you work out what is the cost excluding VAT. Right? So 1254 times 100 over 1.5. So it gives us this amount. Right? So you can see the cost is less than the selling price. So which means now I have selling price limited cost. Right? So it's going to take me to this amount, which is going to be 100 over 115 times times 454,000. Let me take to this balance, right? Less tax value, right? Let's do the calculation of tax value. So tax value, we said is cost. So we saw the cost of our asset with this amount. Less allowances, right? So in regards to this, remember the buildings are quite new. So we have 109,0435 times, right? In this case, we could have done that other thing of doing allowance per year, but you can see, imagine doing allowances per year from 2009 up until 2020. Takes lots of space, all right? Imagine what I'm saying is, if we do allowance, you say 2009, 10, 11, 12, 13, 14, 15, it would take a lot of space. So rather the quickest way, since we're claiming the same allowance on the building at 5%, so we can just take how many years are there, right? From the purchase debt up until the debt, they sold it. So they claim the allowance, all right, in regards to this. They bought the building in this regard from January 2009. So they claimed allowance in 2009. Remember they had January and February 2009. So we have 2009, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Take us to 12 years, right? From 2009 up until 2020. So 12 years, you can say times 12. So these are the total allowances that we claimed them. So 5% times 109,435 times 12. Did I write everything there? 109,435. All right, take us there. Right, we net off these amounts. Right, we need to net off these amounts. And then it gives us a balance there. Right, so our balance is sitting there. All right, that's what we have. So which means recoupment, all right, in this regard, recoupment is going to be 109,0435 minus 436,174. All right, see, there's no replacement when it comes to the building. So the entire recoupment amount is included in your gross income. Right, then capital gain. Right, in terms of this, capital gain, you're going to take proceeds. Right, remember we said proceeds is selling price minus recoupment. So in terms of the building, what is the selling price? Is 2,500,000. So 2.5 minus recoupment, which is 654,261. All right. So this is what will then give us proceeds. Right, sitting there. Less best cost. Right. So in terms of this, best cost is the same as tax value because this asset, there were no additional selling cost and so forth. So best cost is the same as the tax value. So minus 436,174. Right, then take you to this balance. All right, so you have your capital gain sitting in like that. All right, so that's your capital gain. All right. Now, since there's only one capital gain in terms of our asset, we then say less annual. Oh, this is a company. Companies do not qualify for annual exclusion. So we have taxable capital gain. Right? If it was an individual, remember that 40,000 applies to individual, but because this is a company, they don't qualify for that. All right, times 80%. So 80% of this amount is what you then include here. All right, to be part of your taxable capital gain. Right, then you have taxable income before donation. All right, so you net off your amounts. All right, for the donation, it's going to take you to this balance. So you have a balance sitting in, you scroll down. All right, you net off everything there. All right, it will give you this amount. So you have a taxable income sitting there. Then less donations to PBO, Registered Public Benefit Organization. How much is the donation? All right, we saw there that the donation amount, all right, it was, where was it again? All right, so we have the donation and then 8. All right, so the donation of 230,000. So 230,000 limited to 10%. 10% of what? Of 2,312,816. Right. So that's like 2,312,860. So 10% of that amount, it becomes what? It becomes 231,286. Right? So which means there's no limit in this regard. Right? So we have minus 230,000, not limited. Right. Then we have our taxable income there. Like that. So this is what will then give you your taxable income. All right. What was the question asking for? Is it normal tax? They just want taxable income. So you end your question here. Any questions, guys? Right. Cool, guys. Do you think you can crack this? It's a very good question, if I can put it that way. There's a lot of principles, right, that you can of course spend a little bit of time on. Right? There's a lot to learn in regards to this. All right. Please do go for it. All right. Please, 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 guys, spend time here. All right. Questions before we close, guys?
Hi, sir.
Yes, ma'am.
Yes, I just want to ask you something. If the limited amount is more than the donation, we're going to write, let's say maybe it was 250,000, we're going to write 250,000 a year.
So you're saying if the donation, let's say this donation was 250,000. No, we're going.
The calculation we got here, if it's going to be 250,000, it's more than the donation. No,
Okay, look at it this way. All right. Limitation, 10% of taxable income of 2,312,816. All right, it gives you how much? So 10% of this amount. Take you here. Do you see? It's 231,000. 231,286, which is more than 230, which means now the donation amount is not limited. We get a full deduction. But let's have an example. If 10%, if taxable income was, let's say, 1.5 million. All right. In this case, the donation was going to be limited to 10% of 1.5, would you take you to 150,000? So which means here, we're not going to deduct 230, but we're going to deduct 150,000. I don't know.
Okay, so yeah, I understand. Thank you.
All right, cool. So basically that is how it works when it comes to donations. All right. I urge you guys, I think this document contains about 80%, right, of the taxable income when it comes to companies. So please do spend quality time on this document. It's very detailed. It has many principles. Right? If you spend good time on this recording, I think you'll do well in the upcoming exam. Right. Have a good weekend, guys. It's almost over.
Ian?
Yes, sir.
When you're sending the recording, can you also send a PDF document?